Investors, we hear, have a smorgasbord of investment opportunities coming their way over the next few months, with the IPO market expected to take off. Floats of all sizes and from all sectors. I'm joined now by fund manager Roger Montgomery. Roger, hello.
Hello, Ticky.
Well, now, where is this pipeline coming from? What's involved?
Well, what we're seeing is a combination of a number of things. We're seeing a buoyant market and a dearth of value in the market, but a seemingly insatiable appetite for new floats. I can remember just recently there was a capital raising for G8 Education, which is the business that has taken some of the childcare centres that ABC Learning Centres used to own. They were trying to raise $60 million. They accepted $80 million and they had bids for $450 million. So there's enormous appetite. And I think what's happened is some of the companies that were thinking about listing have seen that there's this unsatisfied demand from those who missed out, and so they're taking advantage of that.
But there's obviously a sort of feeling that the stock market is going to continue to do well.
Well, I think, look, I believe that if conditions don't change materially, we continue to see low interest rates, we don't get a recession, we don't get rising unemployment.
And the sky doesn't fall in 2 days' time.
Well, look, I mean, the financial markets love to be worried about something and scare everyone, but really, I think one fund manager in the US said there was about a 600 billion to 1 chance that there would be a default. So if conditions remain the same, there's no reason why we wouldn't think that we're going to see buoyant prices for a while and continued demand for these floats.
So is the traditional sort of private equity taking advantage of this?
That's some of it. That's some of the floats. So, for example, Channel 9, Dick Smith, for example. But we're also seeing the potential for government floats. The New Zealand government is floating some energy companies. We've got Medibank Private potentially listing. We've also got some founders selling. We saw Oz4X float recently, and that was the sellers, the owners, the vendors selling down. The previous owners selling down, the founders.
Now, you've mentioned many different potential floats there, floats and potential floats. How would an investor know that it's not being that they're not being sold a pup? Okay,
well, it's possible, isn't it? So Myer
sure
is an example.
It's happened before.
Myer is iSelect most recently is an example of that. The prices dropped considerably, but then you get other ones where they go very well. So what do you need to look for? You need to know where the money is going. Is it going to the owners who are selling down, or is it going into the business? You need to know. For example, if there's going to be if the expectations for profit are unrealistic, for example, and the last thing that you want to know is, what you should look at, is the pro forma balance sheet. Have a look at what the balance sheet is going to look like if the float goes ahead, and see whether or not that looks like a good business. So
a Channel 9, for example?
Well, the issues with Channel 9, I think, look, in the short term, it's going to be pitched with the prospects for synergies out of the purchase of the Perth business, and this is the first time Channel 9 has had 5 capital cities and owned it under one roof. So that's one issue. But longer term, what you've got is you've got 9, 7 and 10, like 3 Goliaths in a room playing poker together with the windows and doors closed. They've got a fixed amount of money. The population of Australia isn't growing dramatically, and they only win when the other one loses, if they've got a good suite of programs.
Yes.
And next year someone else has a great suite of programs. So I think the long-term economics for that business isn't attractive.
You've got to look at the management, I guess.
Exactly. And Dick Smith's another one that's coming up.
All right, well, let me move on for a moment because at the same time that all these floats seem to be appearing, the ASX has just launched its new book building service.
Yes, the ASX book build, that's right.
So now this is, normally in a float you have a period where, say 10 days or so, where you've got a price range that the issuer, the company, is going to come in at.
And it's all very Machiavellian.
It's a real dark art. I mean, I can remember back in the 80s, dare I say it, working for a Swiss bank, and the head of the syndicate desk, he was this Rolex-wearing Swiss guy, and it was all done with mirrors. Now, this is supposed to be really open and transparent, and retail investors taking part.
Yes.
Is it going to work?
Well, look, I think initially, let me say this, I believe initially it'll work for small companies. So we saw Jeff Wilson's WAM Capital, for example, raise some money today and raise more than expected, another example of demand, to cover a shortfall in the dividend reinvestment plan. So I think it's going to work for small companies where they're not too concerned about who's going to be on their register, and they're not concerned about whether the shareholders who they give shares to are going to sell them after the float float. But for the time being, I think the equity capital markets and investment banking guys are going to say to companies that are thinking about floating, look, if you care about your register and if you care about the aftermarket support, then you really shouldn't go with that completely transparent way. Now, ASX Book Build have some counters to that and are saying, well, you can control who gets your stock and you can cap the amount of capital. But I think for the time being, we'll see smaller companies only.
That's a very interesting play, Roger. We'll watch that closely. Thank you very much for joining us.
It's a pleasure, Ticky.